Hello, everyone. I'm joined today by Tony Manini, Chairman, and Darryn, McClelland, CEO, who are going to run through a few slides on, covering our recent release on the BKM Optimisation update.
Thanks, Sasha. And as Sasha said, this is really a follow-on from the news release we put out last week. It's all about the BKM Optimisation work, the work we've done to date, what we're seeing, what we've got coming, and really why we're doing it and what it all means. The primary driver behind this work is really to lower the total project funding, and the key driver for lowering the total project funding is a lower capex at the front end. We are looking to reduce that capex, that construction capex, by somewhere in the order of 50 to 80 million. That was our target that we set out. Thus far on what's been delivered to date, and Darryn will go through a few of these things as we go through the presentation, we've found somewhere in the order of $26 million of capex reductions. That's off the total capex base from our 2023 feasibility study capital cost of $235.4 million. So significant cost savings already identified, as I said, targeting that 50 to 80 million. So that's a 20 to 30% overall reduction. Lowering the upfront capital costs, really the key driver for that is to significantly enhance the financing size. So reducing the size of that total financing and opening up, a range of options to complete that finance. And we'll talk about, what types of things that we're looking at as we get towards the back end of the presentation. So the optimised project, really it's about enhancing the economics of the overall project, improving that capital to NPV ratio. So, trying to keep the NPV as high as we possibly can while simultaneously reducing that front end capex. By doing that, a smaller project, we also reduce the overall footprint. That lowers, the overall construction risk. Now, construction risk is an important consideration when anybody looks at a project financing. So the lower the construction risk that we can achieve, the better off we are in terms of the project financing. And the way that the project has been optimised, it's really about, how quickly we can get up to first production, how quickly we can get revenues. And clearly, the faster we can do that, the better the economics look by bringing forward those initial cash flows. So they're the key drivers. That's the reason that we're doing this work. And, so far it's been, we've got some great results, and we expect there's more to come. Well, there will be more to come, and we'll progressively report on those as we go through. Next slide, please, Sasha. So I might just stop there for a second, the reasons why we're doing it and what we're looking to achieve, and I'll hand over to Darryn now to talk about, a little bit of detail around how we've achieved the savings and how we're going to achieve more savings. So over to you, Darryn.
All right, thanks for that, Tony. So looking at the aspects of further cost reductions, so a couple of the key areas that we're continuing to work on, that we'll be reporting on. Primary driver, the project bulk earthworks, was sort of the largest single area of capex in the project previously, driven a lot by the scale and the requirements for the heap leach facility. So the work we've done on relocation of that facility and its redesign, introducing stage construction, has significantly reduced the volumes that are associated with that part of the project. So direct costs, but also that's one of the key drivers for being able to potentially reduce the construction time, because the heap leach facility was the critical path item in the previous project. So sort of moving that potentially off the critical path is really important to try and look at bringing the overall construction time down. The contract strategy is another really key area that we're working on. This is an optimization of fleet that is, we have a higher potential to bring this forward and to be able to execute this because of the scale of mining. The scale of mining is reduced, which we'll talk about shortly, and that's allowed us to look at just optimizing to have primarily one single fleet available for the initial project earthworks and then moving that into long-term mining. So it has significant cost impacts on mobilisation, demobilisation of fleet, and also generally a cheaper cost of fleet having that over a much longer time period. In terms of the other key areas, a reduction in project scale. So cost reductions that we've seen are coming from fewer and smaller pieces of equipment, which has been, we're working through the work with the engineering partners, Rexline and Bigram. So that's progressing well and generally as expected. That's where the majority of the cost savings have come from in the RNS we released last week. Along with some areas of infrastructure simplification, we've worked on some areas of both process and non-process infrastructure that we've been able to remove from the flow sheet and also being able to downsize because of the smaller scale of the project. In terms of some of the other adjustments, certainly capital efficiency, we're looking at changes to try and lower the pre-production capital costs. We've sort of spoken through those. Also looking at some of the other areas, such as the working capital required to first copper production. Some of those areas will flow through as well as we advance the final stages of this update. And an optimization of the footprint. As we'll show in a slide coming up, we have sort of quite significantly reduced our footprint in some key areas. There's a couple of things strategically for us. It does preserve more of the copper resource in the ground for future development, and it also allows giving ourselves some space for some critical aspects of potential future expansions. Right, next slide. Thanks, Sasha. So talk a couple of technical items now. So just in terms of the mining, as we had relayed a couple of months ago in our project physicals update, a dramatic reduction in the mining volumes in what we're approaching now. So major reduction in strip ratio from 1.3 to 0.7, and that's reduced the total mining materials, material mined from 91 million tonnes to 48 million tonnes. And just to give a sense of that scale, the maximum fleet number that we require now to execute mining is reduced from 22 trucks of a larger size, 60-tonne articulated trucks, down to 9 as a maximum number. So you can see the dramatic change in fleet requirements, and that's, as I mentioned before, has fed well into the requirements for the project construction. So that's why we can sort of look at that real opportunity of having the single fleet over both construction and into mining. And just to give a sense of what the actual change in the open pit and what that has meant, just on the bottom left-hand corner there, this is a cross-section through one of the deeper areas of the pit. You can see that a difference between our feasibility study shell from last year and then the pit shell that we're working with now in 2024. Very much focuses on the higher grade material at surface. The big white section between the two pit shells is material that doesn't have any economic soluble copper. So that's material that we're not mining now, and so it's really just it's further focusing on the higher grade material to get that into the plant and get that earlier. And the pit, the depth of the pit, raising the pit floor by around 75 meters. A lot of these things sort of have flow-on effects in terms of, say, particularly costs. The deeper the pit, more costly it is to mine. So mining things closer to surface generally means that the operating costs will be lower as well. This is to give people an understanding and appreciation of the change in scale of the project. So in terms of the process, particularly the processing scale, so our processing rates have been reduced from 4.5 million tonnes to 2.6 million tonnes in the iteration we're working on now. You can see in the figures presented here that we're extending out to 13 years life as opposed to 10 years. So that has that's a significantly longer tail on the overall project, the project mine life, and that potentially could be important for us in discussions with lenders. That's something that they always look at. What is the length of tail past that period of payback and financing? So we're aiming to spend significantly less capital up front, with this scale of project, and also give ourselves a longer tail at the end, which we think will both be positive, outcomes when we are discussing this iteration of the project with the lenders. Okay, just moving on to the optimized mine site layout. So just a couple of key points we'd like to share here. Firstly, the heap leach relocation. You can see that from the 23 FS, the location, we had the infrastructure previously, and now we've relocated that to another area within inside our boundary. So significant reduction of area required to be cleared and worked on in construction, reduction of 50%. So has a significant impact on a whole flow-on effect of the construction metrics in terms of material movements, etc., for construction. So really positive outcome. It's also left that the area where the heap leach was situated last year, it's actually left that area vacant for future development, and probably one of the key areas of developing the BK area and KSK into the future is tailings management, given the likely processing routes we'll be going through. So, after a review, this is a really one of the really probably better areas within our mine footprint that would be available for being able to place tailings. So I think it's quite an important future sort of strategic option for us to be able to have that free for the longer term development of BKM, BKZ, and other deposits. And just specifically on the waste dump, the footprint, the capacity of this waste dump is allowed, we're able to reduce that by 62%. The amount of waste we're mining is dropping from 52 million tonnes to 20 million tonnes. So, much smaller footprint and flow-on effects of the costs for, initially developing the footprint for the waste rock dump and a range of other sort of management activities, associated with that, really help to drive down some of the costs, the longer-term operational costs for mining. Thanks, Sasha. So the final technical item I just want to touch on is the power solution, such a critical aspect of the project for BKM. So we're advancing a build, own, operate power supply model. We have, because of the change in scale of the project, the scale of the power supply also needs to be updated, where the power supply requirements are reducing from around 12 megawatts to 7 megawatts. So we're engaged with several tier one original equipment manufacturers, helping us updating a capital cost estimate for the smaller biomass power plant. So that's groups that are specialists in the boilers, turbines, and generators for this type of power plant. So that work's progressing well, and sort of looking forward to seeing some of the outputs. Looking forward to seeing the outputs that are coming from that, certainly in the next couple of weeks. This was a really key de-risking activity for the bank financing. It set being able to show a clear path and advancement of the biomass power solution for BKM was a critical item from the ITE work that was done, and also some follow-on discussions with lenders that we were having last year. So they're really advancing this and being able to demonstrate a clear path forward as to how we can execute the biomass power supply for BKM. The ownership of this process, it's intended to be an independent power producer. That's what we call here. So they retain ownership, and they'll be responsible for construction, operation, and maintenance of the facility. And power will be sold via what we call a power purchase agreement to us. We're targeting for completion of an MOU with a preferred set of partners in the near term, and the partners, that will be a combination of the IPP, an EPC contractor who'd be responsible for building the facility, and a specific OEM whose equipment would be used in the power station. So now I'd just like to sort of hand back to Tony just to talk through some of the aspects of the financing pathway. Thanks, Tony.
Yeah, thanks, Darryn. So look, just to, I guess, refresh a little bit on the financing pathway, because I know it's a question that many people have. So what have we done to date? What are the additional requirements, and what does the optimization mean for all that? So in terms of the debt finance process, as Darryn alluded to, we've undertaken the ITE review. Everyone's heard about that. That was a pretty extensive process, which has now been completed. There was a number of things come out of that process that the lender required us, and there was some of those things were relatively simple and easy to address, which they have been. Darryn, maybe just to give a flavour of what those couple of, 2 or 3 things look like.
Yeah, sure, Tony. So a couple of key things. One was just going back to the biomass power station. The lenders were keen to understand the source and availability of biomass for that project, and so we did quite an extensive survey of the biomass palm oil mills, closest to, in and around the BKM project to clearly demonstrate that we had ample, more than enough biomass material available for the scale of power station that we're considering for BKM. So it was a key area. And another key area was being able to identify development partners, execution partners for the project, in terms of earthworks, structural, mechanical, all the construction disciplines, wanting to know which groups we would likely go with, and so they could assess who, the nature of those groups and their sort of suitability for being able to execute this work. So we're able to be able to demonstrate who we would likely go with, and certainly we're working with partners now which were identified back in that process, and certainly think that that's going to hold us in good stead when we come to finish this work.
So thanks, Darryn. So in addition to that, we built a full financial model. So really a debt sizing model. We've worked with the potential bank lenders around developing out a full debt sizing model. That's actually been finalised and tested with the lender, so who was happy with what we'd built out there. So that's all been completed. So in terms of key additional requirements for debt financing, there's sort of 3 key items that we're working on. So the project execution plan, which we've already talked to, the power supply, Darren's been through in some detail, and we need to drill evaluate the local limestone source, given that we need significant amount of lime for our process, and in the feasibility study we had a local lime source there. We have identified that, and it will be suitable. It just needs the work to be done. So look, each of those things, so while we're progressing the debt finance to the credit approvals, into the credit approvals process, we'll continue to work on these things and working on these things simultaneously to deliver into that debt financing and that credit approvals process. So that'll all happen sort of simultaneously, and hopefully the plan is that it all comes together near the end of that process. The work that we're doing around the optimisation, reduces, as I said, looking to reduce the overall size, reduces the execution risk. It's an important consideration in any financing. Darryn alluded to the smaller footprint and so on and so forth before. So reducing execution risk is an important consideration, and looking, at a capital cost up front, which is far more manageable in terms of its overall size. So look, what are we trying to achieve out of this optimisation work? We're really looking to get the total funding package to less than $200 million US dollars. We were at 235 previously. I emphasize less than US 200 million. Clearly, we said 50 to 80 is the target, and that's what we're very much focused on. In terms of where is the funding going to come from, we've already talked about senior debt finance and the work that we've done to date there and continue to do. Working on those key items, to deliver out of the optimisation work simultaneously with the credit approvals process and bring those together into completion. Offtake prepayment, we've mentioned this previously. We've already had a term sheet put to us from one of the large global trading houses, and will, as part of the ongoing financing, will continue to engage with that party and other parties who have undertaken diligence work, and we'll revisit that. But we won't be doing anything there until we get the senior debt finance in shape. There's the other options that we're sort of looking at, project level equity. So, we'll have an equity gap to solve. The senior debt finance, we'd expect that to be somewhere in the order of 50 to 60%. The offtake prepayment will be a decent amount, and then between project level equity, some shareholder equity, and potentially other sources, you will have seen people doing various things around royalties and streams and equipment finance and various other things as part of their overall capital stack. Clearly we'll look at all those options to come up with what we feel is the best solution for our project in terms of the capital size, the risk profile, and the certainty that we have. So that's how we're approaching it. Lots of work being done. Some really good outcomes out of the optimisation work today. We expect a fair bit more coming from that, which we'll report progressively over the next few weeks. And then simultaneously, we'll continue to push hard on the financing alongside that work, which is a critical part of the overall project financing. So they all tie together, and that's the way that we're running them.
Okay, and just following on from Tony's wrapping up there, certainly over the course of the next sort of short period, we're continuing to advance all of the engineering work, the engineering optimization work. So we expect to be able to share more details on capital cost reductions that are coming from the engineering efforts, the rescaling, reshaping of the project, those particular items. The big ticket, I guess the biggest ticket item which we'll be advancing is the updated cost of the earthworks. That's a little bit further down the track, but certainly we'll be discussing outcomes of that work as soon as we can, as soon as we bring that all together. But it's really important, a really critical part of the capex reductions which we're seeking, that $50 to $80 million, the overall project earthworks, and our approach to that is a real large piece of that. So certainly in terms of other news flow, we'd like to be able to share some more details on the work we're doing around power. Just sort of working through the various parties and getting to a point where we're able to share that with our shareholders will be good, but we're still having to work through some things with the OEMs and the other parties before we can release information on that publicly. So there's still a lot of work happening, and looking forward to being able to share more of the details over the course of in the near term.